you kind of have this multi-month window here where liquidity looks okay, but then the big challenge is that when they actually do get to the debt ceiling impasse, however that's resolved one way or another, when the Treasury actually then wants to refill its cash account and wants to, is able to issue debt again, that's a lot of new supply coming onto the market, and we're going to see how the Fed deals with that in terms of a liquidity response. And so overall, I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Investors hoping for a kinder year after 2022's bruisings have been disappointed so far with 2023. If anything, things are even more unstable so far this year. Are things likely to equilibrate and give the bulls room to run? Or will the challenges of stubborn inflation, high interest rates, accelerating debt, slowing economic growth, and continued geopolitical stresses demand a reckoning? To discuss, we're fortunate to be joined today by respected macro and market analyst Lyn Alden. Lyn, thanks so much for joining us today.
Thanks for having me. Happy to be here.
Oh gosh, Lyn, it's always a pleasure. I told the audience that you were going to be coming on the channel soon, and folks could not be happier. So let's just dive right in. Let's start with a question I like to ask you every time you join us. What is your current assessment of the global economy and financial markets?
So I think we've hit some of a pivot point. We've gone from obviously aggressive tightening toward the Fed kind of running into somewhat of a liquidity wall, and now they have to balance financial stability with their attempts at fighting inflation. And so I think that's kind of the big story in financial markets is this kind of pivot in liquidity. I think the challenge is that we're still in this kind of stall speed area. So a lot of economic indicators have decelerated without going negative. And so they're either mildly positive, roughly neutral, maybe in some cases mildly negative, and other ones are still pretty strong. And we have this kind of window here between now and the debt ceiling where liquidity looks pretty flat overall. So the Federal Reserve was draining liquidity. Now it's kind of a messy situation. They're still, on one hand, they're pulling liquidity out with quantitative tightening, but then they're putting even more back in with loans. You have the Treasury General Account is still structurally drawing down its cash reserve as part of its extraordinary measures when it runs into its debt ceiling. And a lot of that's already behind it, but there is still some to go. And so as they draw that out, that goes out to the economy, and that's actually pro-liquidity. So you kind of have this multi-month window here where liquidity looks okay, but then the big challenge is that when they actually do get to the debt ceiling impasse, however that's resolved one way or another, when the Treasury actually then wants to refill its cash account and wants to, is able to issue debt again, that's a lot of new supply coming onto the market, and we're going to see how the Fed deals with that in terms of a liquidity response. And so overall, I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon. And there's almost two economies, right? So obviously very interest rate sensitive sectors, which is things that are really reliant on debt or issuing tons of equity, ironically. So if you look at the real estate sector, obviously that employs tremendous amounts of debt, and therefore that's very interest rate sensitive. That's obviously been a point of concern both residentially and commercially. And then the other one is tech. And people don't often think of it as a real estate, as an interest rate sensitive sector, but it is, because especially in this past decade, so many tech companies have in some cases sold their equity better than they sold their products. And what I mean by that is they keep their prices low, they operate at a loss, and they make up for it by constantly selling new equity, both to their employees and to investors. And that's what allows the company to keep going. And that works as long as interest rates are like zero and people are willing to just keep monetizing that equity. But when there's actually a cost of capital, that equity gets valued very differently. It's no longer economical to keep issuing tons and tons of it. And then the company has to raise the prices to try to close the loss that they're making. And then that slows down their growth because some of their growth was only there because their products were underpriced. And then as their growth slows down, their equity valuations fall further. And you basically find out that a big percentage of that business was malinvestment, that there really was no there. It was just a underpriced thing that wasn't getting its market signals due to manipulation. And so those are kind of the two sectors that are obviously most concerning. Whereas you don't really see much stress in the travel industry and the restaurant industry, in certain other parts of the real economy. There's kind of a bifurcated economy.
All right. I want to dig into all this with you. This is all great. Let's see. Let's start with the Fed, and then let's head into those interest rate sensitive areas. So you talked about how there's this kind of interesting, messy moment right now where the Fed is still raising rates and it's still doing QT, but it's also pushing loans out to the bank, right? Banks as part of the, propping up the bank system right now. So that is sort of pro liquidity, at least the loans part. They're not necessarily flooding into the economy the way that you might expect more in QT, or sorry, pure QE, but they are helping, right? Then you have the TGA, the Treasury General Account, you said, right, which is pushing money out into the real economy. I don't know a person on the planet who doesn't think that the debt ceiling is going to get raised. I assume you're in that camp too.
Yeah, I mean, I think there's challenges. Obviously, there's frictions. There's all sorts of things. But at the end of the day, I think they're going to raise it.
Yeah, so they're going to raise it. So then the Treasury is going to need to start refilling the TGA, and it's going to be doing that by selling Treasury bills and notes and bonds. That will start draining, or at least it'll stop pushing the liquidity out that the Treasury has been doing. So first question is how like what's the magnitude of that? Is it going to be relevant enough to notice when that spigot gets turned off?
Well, it's hundreds of billions of dollars. So that's the rough magnitude. I mean, basically, it was actually starting in the beginning of Q4 last year. For the first 3 quarters of 2022, liquidity was falling because the Fed was, doing quantitative tightening, and that kind of culminated in the Treasury market was getting very liquid by the end of Q3, and then you also had the gilt market blew up.
Sorry to interrupt, but that's when Janet Yellen began raising these flags of cracks in the Treasury market.
Exactly. And you also had the dollar index kind of hit its peak, and that all kind of ended up around the late September period. And the Treasury General Account started drawing down more quickly at that point. And you actually, measures of domestic liquidity started trending sideways rather than down throughout Q4. And that kind of coincided with the dollar index coming off of its highs, the market coming off of its bottom. Treasury market liquidity still wasn't great, but it was no longer as bad as it was in that time. And so for kind of a multi-month period, we're in that sideways sort of trend. And that was in large part because the TGA was big enough to be offsetting some of the quantitative tightening. So that gives you an idea of magnitude. They drew it down from many hundreds of billions, and now it's below 300 billion. And so that was large enough to offset a significant percentage of quantitative tightening. Going forward, there's only, there's less than 300 billion left. It's still relevant on a scale. And when they get to a point where they want to refill it, I mean, their kind of baseline number for where they want it is around $500 billion. And so that's if they draw it down to roughly zero down to the hour during the debt ceiling, and then they want to refill it, that's $500 billion that wants to get sucked out of the market into this like liquidity void. And so it's smaller than reverse repos. But it is a meaningful percentage of it, and especially when there's already liquidity issues in the system, it's certainly a meaningful variable.
Right. No, that's what I wanted to put the spotlight on here, and so interesting. So sort of starting around Q4, we had the monetary brakes being put on, but we had sort of this fiscal accelerator that was being pressed on. Now the accelerator will come off at some point. Listening to Powell and the Fed, they're still going to keep their foot on the brakes, right? They'll still be tightening, or at the very least pausing here, right? And probably still continuing QT. So sort of what you're saying is, or what I hear you saying is, hey, there's going to kind of be this shoe that's going to drop here of receding liquidity. And then, of course, you add to that the incremental tightening of credit standards of lending that is going to go on now following the shakiness in the banking system here. And Jerome Powell talked about this, right? He said, hey, those substitute for additional rate hikes. So, he just hiked the Fed just hiked 25 basis points last week, but he said it's really more than that because we're going to have the impact of this additional tightening on here. So you have that. So that is constrictive to the economy. And then you have one of the things I've been talking a lot about in this channel, and I'd love to get your opinion on, is the lag effect, right? Of the 450 or so basis points hikes that have been made that we haven't really, as best we know, felt in force yet. They kind of travel through time. And so we have kind of the parade of shockwaves from those past rate hikes still traveling through time that'll be hitting the economy again and again and again over the next couple of quarters. So how concerned are you about this, kind of perfect storm almost, it sounds like, of additional liquidity contraction, tightening lending standards, continued tightening by the Fed, plus the lag effects, the avalanche of lag effects coming our way?
I think it's really concerning for quarter three or quarter four. I think right now we're in a little bit of an eye of the storm where, like I said, liquidity indicators look okay looking out a couple months because you kind of have liquidity being taken out and other liquidity being put in. And the question is, when you get, towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system, and a lot of it will come down to human decisions. And there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019, and they did so until September 2019 when they caused the repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But there are a number of us at the time that were pointing out that they were basically, the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills. And about 3 weeks later, that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that they necessarily turn to QE right away, but I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system. And another factor that's challenging is that, the Treasury generally has options. I mean, they could, for example, when they want to refill their Treasury General Account, they could issue almost entirely T-bills. They could issue a flood of T-bills, and that would pull liquidity out of the reverse repo market most likely. And so that would actually be the least harmful way for liquidity in order to, carry on. But of course, it would shorten the average duration of U.S. Treasury debt. It'd be the least interest rate effective way to do it. So again, it kind of comes down to like choices by Yellen and others of how they want to handle that. And one of the things we've seen recently is that they don't generally respond well to technological changes. And technological changes are things that kind of move slowly, but then they move all at once. And what I mean by that is when you look at the history of fractional reserve banking, it's kind of based on the premise that the settlements are slow and the transactions are fast. And what banks do is they provide that arbitrage in between. So if you go back to, say, a gold-based free banking system or something like that, the gold itself is slow. But then once you say deposit gold in a bank, you're now part of this like telecommunications connected global ledger that allows you to move money around quickly. And so there's relatively few reasons why people want to pull their money out. It's generally like you're pulling it into a slower state when you pull it out of the banking system.
Mhm.
And so they kind of rely on people wanting to have their money in the banking system to benefit from that speed. What we've seen kind of in recent years, recent decades, is that the settlement speeds have especially it's all fiat now, but even in a fiat system, when you add social media, when you add, some of these banks that failed, for example, they had software APIs where they could just tie their money management right into the business's software. So like people could basically pull their money out without really interacting with the bank in question. And the easier it is to deposits to move around, the more it changes liquidity needs for these types of banks, right? You can't cut it with like 5% of deposits covered by liquid cash.
Mhm.
I mean, there's a broader discussion around fractional reserve banking in general, but even among fractional reserve banks, it's like there's different levels of liquidity. It's like, can you take a 5% bank run or can you take a 50% bank run or anywhere in between? What's the number? And basically, as that speed mismatch between settlements and transactions has closed, and as like the settlements can move around super quickly, those liquidity thresholds that are so low don't really cut it anymore. And so the Fed's basically ironically pulling liquidity out of the system in a world where because of technology, they need more liquidity.
Right. Right. All right. Well, that's super interesting. And I guess let's tackle this head on for a second. So we've had a couple recent banking failures, both in the US and in Europe. The banks that failed here in the US largely failed because of what did them in fatally was reasons that were idiosyncratic to those banks, but they were vulnerable for on several fronts. But one big one that a lot of banks are vulnerable from right now, which is the Fed and other central banks brought interest rates down to historically low rates and held them there for a really long time. And so the banking system adapted, right? And it's a borrow short, lend long, type of model. And they optimize that around interest rates being super low and continuing to be super low. And then all of a sudden, the Fed raised interest rates faster than at any point in history. And sort of the analogy I've used is it sort of got everybody used to driving 100 miles an hour in the car, and then it just jammed on the brakes, and now the bodies are slamming into the windshield here, right? So I guess where I'm going with this is you're nodding as I was saying that, but like how big of an issue and how persistent is it going to be in the banking system? In other words, is the banking system going to be able to kind of react to this and we're going to be okay, or is for all these additional tightening elements that you're talking about, are we placing greater and greater stress on the banking system at this point?
So I think there's three different layers here. One is, as you point out, the underlying Fed actions. Basically, it's hard to operate when the Fed is zigzagging all over the place. A lot of people can criticize them for cutting interest rates super low and doing all sorts of QE. But for consistency, I mean, if they jack rates up super quickly and they do quantitative tightening super quickly, it also causes problems. Basically, it's like you're changing rapidly the entire monetary base of the country to try to either in some cases they're trying to have inflation be higher, ironically, other times they're trying to make inflation lower, and the speed and the aggression with which they move around makes it a very difficult environment to operate banks, do long-term contracts, run a business, right? It's a very actively managed system, and I think there's a lot of criticism that can be kind of put at them and say, does it need to move around this quickly? Like, what do you like? The active management that's happening is I think overdone in both to the upside and the downside. They always seem to push it too far, and it's like this doesn't need to be like that. And the next layer up is obviously certain banks handled this environment better than others. Some of them became more addicted to the environment than others. Other ones were more sober-minded, and kind of positioned themselves to a potential ending of that environment. And so some of the banks that ran into the most problems are ones that did the most long duration types of securities.
Right.
The challenge is that
or didn't hedge like Silicon Valley, right? Yeah.
or that didn't hedge. And a challenge is that everybody's right now focused on the unrealized losses in securities, but there's also unrealized losses in loans. And the loans are less liquid, less transparent,
Yep.
And that's what banks are kind of supposed to do in the current environment. They're supposed to take in deposits to make loans, including 30-year mortgages, including, these types of loans. And so they're really kind of supposed to do this duration transformation. And now they're in an environment where they're getting rapidly punished for that duration transformation that their whole premise of existence is to do. And so larger banks, like say JP Morgan, but even just like large super regional banks, they can hedge better. They can have a bunch of short duration securities to offset some of their long duration loans. They have a lot of options available to them, whereas small and medium banks, they have a higher percentage of their assets in those loans. And they just have kind of less just overall tools to deal with those types of liquidity problems. The third layer of it is that, so historically, when the Fed raises rates, you don't see a lot of action from bank deposits. There's generally, rates go up, T-bills go up, but bank deposits stay pretty low. And so that gap widens between deposit rates and, say, T-bill rates. And it's often because it doesn't last very long before the Fed causes a problem and has to cut. And also because people just feel safe in their banks, especially if you're a business and you're actually using your bank for payroll and like money's going in and out. But if you stay in an environment where that gap is larger than normal and it's longer duration than normal, then more deposits want to flow towards those higher yielding and safer things, which forces smaller banks to raise deposit rates in a way that like JP Morgan doesn't have to raise rates because everybody wants an account at JP Morgan. So they can hold rates at like zero, whereas, community banks, regional banks have to raise deposit rates if they want to avoid deposit flight. And then the problem is because they lent at long durations at low rates, even if they don't have a liquidity crisis, they start to have pressures on their profitability.
Right.
And their ability to make new loans, their ability to retain employees. They're more likely to be targets of M&A activity, right? Because if you have multiple small banks that are barely struggling with profitability, they're more likely to merge together or get acquired by a larger competitor. So I think one of the challenges is that this is going to slow certain things down, but it's also going to result in more and more bank consolidation.
Yeah. Okay. I've been talking about this recently on the channel, which is I was going to get to this question, but we'll just put it out as a conclusion here, which is that when the dust settles from this current round of banking dyspepsia, it's likely that we'll have fewer banks and that the too big to fail banks will probably be too bigger to failer at that point. Okay. For the audience, you're nodding and smiling as I said that. All right. So just a couple quick things on this, and then so this has been great, Lyn. I haven't even gotten to my questions for you yet, so I'll be expeditious in getting to them. But you talk about how the individual banks are more vulnerable than the really big ones for a whole bunch of reasons. How worried are you about on the loan side of the business? If we're going into a challenging second half of the year, as you said earlier, particularly with like tightening credit standards and stuff like that, and potentially higher defaults because we're getting into maybe a recession or close to it. The smaller banks seem to have a much higher exposure to the commercial real estate market, which is one of these high interest rate or interest rate sensitive areas you were talking about. From what I hear too, it sounds like the auto loan market is going to be pretty awful this cycle. It's going to be almost sort of like the housing subprime that we had back in 2008. So how concerned are you about those shoes when they drop on the banking system, at least on the smaller banks? And really by smaller banks, I think I literally mean like any bank that's not in the top 10, because there's such a huge gulf between those big guys and everybody else.
Yeah, I think there's a lot of concerns about both commercial real estate and autos. The difference, in 2008, because it happened in housing, and housing is like, the biggest loan area, right? That was a more kind of existential crisis among even the big banks. Whereas in this environment, obviously the duration and interest rate mismatch has been a problem. But in terms of credit, I'm less concerned about overall credit contagion. while still being concerned about pockets of bad credit. So like in auto lending, banks that are very exposed to that, as well as commercial real estate. And even in commercial real estate, it's like you have to kind of segment by type, right? So office space versus like real estate for a restaurant are two very different types of commercial real estate. And so, for example, some of the travel spaces, some of the warehouse spaces, some of the restaurant spaces, like that kind of stuff is generally doing pretty well. Whereas like office spaces and certain other types of real estate are the ones that are really suffering. And then even across the board, even if a property itself is marginal, if the valuations were very high when it was kind of financed with low interest rate debt, as more and more of that matures and comes due, that causes problems, and then that cascade into defaults because they can't roll their debt properly, and they might even have a higher chance of defaulting on the earlier loan. And so that's kind of another problem that the small and medium banks face. In addition to having raised rates to keep deposits, they also have that higher overall exposure to commercial real estate. So I think that's one of the areas of the economy to be concerned about, and it slows things down, causes problems, while other parts are either immune from it or benefit from it. Because if liquidity and rates have trouble tightening due to problems in those sectors, it allows other sectors that are not harmed by some of those problems to keep carrying on.
Right. And so their relative performance becomes a lot better. All right. The last question on the banks, then I want to get back to the Fed, and then I want to get to a bunch of other questions that you are known to be a great expert on. You talked about deposit flight, right? And that's an interesting dynamic that's going on right now, which is, finally safe assets are providing a decent return in this environment, and they're providing a much better return than banks have been offering, in their savings accounts, right? So you're getting more and more people just saying, hey, you know what, I'm going to put my money where it's better treated, right? And I understand that now banks are challenged to raise their deposit rates to try to, win that business back for reasons you already mentioned. But like how, I put the biggest blame on the central bank policy, as we talked about earlier, but like how it faulted the banks for just being too damn greedy in not raising their deposit rates, especially once they were getting a much better return on, their interest on excess reserves at the Fed, but just not passing any of that along to their, deposit holders.
So I think that as a general rule, corporations are greedy, right? I mean, a small business can operate differently because it can be more heavily influenced by its leadership team, its founder. But when you're a large distributed entity, your general goal is profit maximization. And so whether it's Coca-Cola or whether it's banks, I mean, pretty much any sector you look at, they're always going to try to maximize their profits. And, especially when you're a smaller bank and you're looking at the JP Morgans of the world, like they're holding rates at zero because they can, because no deposits want to flow out of them. If you're a small bank and you're sitting there saying, well, if we raise rates, now we have worse funding costs than JP Morgan, as well as all the other disadvantages we have compared to JP Morgan. And so I think banks only raise deposit rates when they have to. It's kind of like it's the market at work. Basically, if they're not getting signals telling them they have to raise deposit rates, they won't. And if they start getting signals to raise deposit rates, and they will. And of course, the problem is that it can kind of happen all at once. Like they could not get the signal, not get the signal, not get the signal. But then if suddenly people are concerned about bank safety, they get all the signal at once. And so, bank greed has always been a theme. And just I think like any other company, banks are pretty much always greedy. And there's smaller banks that are serving their community. Like I have a local credit union. Their deposit rates are terrible. But they're not really operating on like a greedy perspective. I mean, they're serving their community well. There's really no excess compensation going on. They're just kind of operating in the rates environment that they're given. And so I think that's kind of what we see overall, is that it's kind of the market, kind of all the water just keeps settling to where it goes. And if it starts to drain out, then they have to raise rates to keep it in.
Okay. I guess I was trying to go here was this like an unnecessary self-inflicted wound where they just waited too long to do this and, now can't really, but it sounds like you're saying it's maybe a little bit more market driven.
Yeah, I think that so it's more market driven. It's also Fed driven. I mean, Fed, just it's rather reckless with how quickly they move
Right.
things up and down. And then I think where the banks, had the most say in how they manage things is with how they manage their duration risk, right? So obviously something like Silicon Valley Bank was on the far side of the spectrum for not managing that well.
Yep.
And obviously there's various choices that banks can make to not have that type of exposure.
Okay. All right. Thank you. Now we'll go from banking to central banking. And the bridge question for that is what do you think of like how do you rate so far the reaction that the Fed and the Treasury and the FDIC have taken so far to the bank failures that we've seen and the general concerns of the populace?
I think the reaction kind of shows what happens when no one's really in charge, and yet they're all kind of a little bit in charge, right? Because you've had this kind of haphazard response where one is they clearly didn't see it coming. The Federal Reserve response so far has, nothing's been really unusual about that. They provided liquidity facilities. They're at, they're generous in some ways, but they're still at punitive rates. I mean, if any bank is using that new, Fed liquidity facility, that's way higher rates than they're going to get from deposits. So if they're tapping into that, they're having a bad time. The FDIC's response, which also is kind of, they can act unilaterally. I mean, if they go above their normal functions, they have to then talk to the Federal Reserve Board and the Treasury and the president to do things like cover uninsured deposits. So that was more of a group decision. That shows how arbitrary that is. Basically, I mean, there's between the Treasury Secretary and the FDIC, the question of what deposits are insured and what are not, we've been flip-flopping all around on. We start with a pretty defined set of rules. You're covered up to this threshold. If you're over that threshold, you're at risk. And when we change the rules on the fly, and we're more likely to change the rules for big banks than small banks, that they were basically favoring big banks that already have a number of advantages over small banks. We're basically saying that you have free extra insurance.
Right.
And then the thing is, she won't even commit to that. She won't even be clear about that because she actually doesn't have full authority because the FDIC only has so much money.
Right.
And if they wanted to do some sort of blanket coverage on all deposits, they'd have to get an act of Congress. And so it's kind of a mess. It's both like in that role, it's hard to even know what to say because if you say, these are the rules, that's what it is. Well, the system is so fragile that those rules don't really work well with it, that you basically encourage more bank runs. On the other hand, if you say, okay, everything's FDIC insured, one is you don't really have the authority to do that unilaterally. You can't really necessarily back that up just from the executive branch. And two, it's like, then what are we doing here? Like, why are, it basically makes deposits look safer than they really are.
Mm-hmm. Yeah. Okay. Yeah, and I think part of this is, it's the box that these central planners have kind of put themselves in over time here, right? Which kind of gets to the next question, which is like, what are the Fed's options right now? Right? It's tricky because everyone has been saying, look, the Fed's going to hike until it starts breaking something, right? Well, okay, things are beginning to break, right? But inflation is still, a lot higher than it wants it to. Powell has reiterated, I'm still going for 2%. I'm not coming up on my target inflation rate here. But so he says I'm going to keep fighting that thing, but we should probably expect more things to be breaking. So I don't know. What's interesting is if you look at the CME tool that predicts the odds for a rate hike, it's now 86% odds of no hike for the May 3 meeting. So I think a lot of people are maybe asking, oh, well, are we now at the pause phase? Is that what we're entering? So anyways, what do you think the Fed can and should do at this point in time? Or probably can and will do. Let's not talk about should yet.
Yeah, so I think can and will. I think basically they're at the pause phase. Now, whether or not they try to push a little bit further with another 25 basis point hike or something like that, I mean, around the margins, we'll see. So far, I currently agree with market pricing that they're going to have trouble with anything other than a pause or gradual moves now. When we zoom out to kind of the bigger question, I often bring up the 1940s, and that's really what they find themselves in. So if we go back to the 1970s, the inflation that was happening was a couple key reasons. One is you had the highest ever rate of U.S. bank lending, and that was in large part because the baby boomer generation was entering their home buying years. So you had most of the money creation was from bank lending. Then number two, that was exacerbated by there were larger fiscal deficits. Now they were actually a smaller component of money creation than bank lending, but they were still adding fuel to the fire. And of course, you had oil issues, right? So domestic oil production peaked in 1970 after literally going up for 100 years, and then as it started to go flat to down, we became more reliant on imports, and then obviously we ran into geopolitical issues in the Middle East, where we got cut out of the market for periods of time. And so the combination of supply side limitations, but then also record demand for loans really caused a lot of money creation and inflation. And generally the tool that central banks have to deal with that is to tighten policy, especially because debts as a percentage of GDP, both public and private, were very low back then. And so they could radically tighten monetary policy, get to really positive real yields, discourage a lot of types of borrowing, put the economy into kind of a controlled recession. They basically crushed Latin America. I mean, basically they had all this dollar denominated debt. The dollar spiked, and Latin America had a lost decade, and that basically took demand out of the global market so that other basically United States could have more of it. So it's kind of like throwing one person under the bus to keep yourself afloat. That's the policy they could go with. The 1940s were a different environment, which is that the money creation was almost entirely from fiscal spending. There was no excessive bank lending. Actually, banks were barely lending at all in the 1940s. And yet that decade was just as inflationary as the 70s, because obviously you had massive monetized fiscal deficits to fight the war. But then a lot of that, went to domestic manufacturing. When the soldiers came home, it put 8 million of them through technical schools and college and mortgage assistance and things like that. This is basically a gigantic stimulus in a way, monetized, inflationary. And when the Fed had to deal with that situation, they basically lost independence. They said, well, we have to keep borrowing costs low for the war. And ironically, if most of the money creation is coming from fiscal spending, raising rates doesn't even necessarily address it, because the government's not going to spend less because rates are high. And now their deficits are going to be bigger because they're paying higher interest on their debt. And so actually, unlike bank lending, the interest rate channel is just not a very effective way to deal with fiscal driven inflation. But the most effective way to deal with fiscal driven inflation is to reduce the fiscal deficits, which is not a central bank. It's not in their purview. It's in Congress and the president. And so basically it's their current environment is that here in the 2020s, most of the inflation's from large monetized fiscal deficits as well as supply side constraints. We don't have excessive bank lending. There's pockets of excessive bank lending, but it's just the normal kind of historical baseline of bank lending.
Yep.
And yet they're treating it like it's the 1970s, which is they're treating it as though it's low debt, as though it's mostly from bank lending, and therefore if you're tight enough with rates in QT, you can somehow constrain it. And sure, you can for a period of time if you cause an outright recession. But if you actually want to get to a period of disinflationary growth, the ways to do that are improve the supply side, so better access to energy and things like that, as well as restructure some of the deficit spending. But neither of those are actions that the Fed has. And so I think that one of the problems is that we put so much burden here on the Fed to deal with it. And it's just not, they're only one part of the puzzle in this kind of mess that we've created over the past couple of decades. And so
the weapons they have are not effective, or not
Yeah.
as effective for this particular situation.
Yeah, and the challenge is that, so the way that they dealt with it in the 1940s is, one is they kept rates low despite high inflation. But then the problem is if you keep rates too low during inflation, then you can actually encourage excessive bank lending, because, right now in Turkey, if you can borrow lira for a low rate, why wouldn't you? You buy almost anything else. if they're not going to raise rates to positive real levels. And so if they don't raise rates in response to fiscal driven inflation, they can then encourage bank lending driven inflation because everybody wants to borrow more of it, create more of the currency, and buy something harder with it. And so what they generally turn to is a mix of keeping interest rates low or moderate, and then doing capital or lending controls, which obviously is a big problem in its own right. And so I think that's kind of the environment that we find ourselves in going forward, where they have limited tools to address inflation directly, unless they want to cause an outright recession. And even if they do, then the question is, well, what do you do after the recession? How do you accelerate without causing another round of inflation?
Right.
And I think one of the things they're going to try is just very, basically tighter restrictions on bank lending. They're basically trying to slow down bank lending while still keeping treasury markets liquid. And it's kind of the 1940s playbook all over again.
Well, that jives very much with what Powell was talking about. He kept talking about expect tighter bank lending going forward. So maybe they're already sort of trial ballooning. Get us ready for that. That's super interesting. Okay, so I wanted. There's three things I still want to get into with you with the remaining time we have left, which is going to be unfair to you, Lyn, because we're going to have each one of these could have been the whole video. But I do want to get a little bit more into your macro outlook and how you think the rest of the year is going to proceed. Want to obviously get your market outlook in terms of how you think that's going to translate into what the markets do. And then if we have time, and if we don't, we can punt. But given what's gone on this year, and given its recent resurgence, would love just to get your quick thoughts on what's going on in crypto, because I'm sure there are elements of what's happened in the banking system where a lot of crypto people have said, "Hey, this is what we're talking about," right? But if it's too big of a story and we can't do it justice, we'll talk about it later on. All right. Well, I'm trying to figure out which one of my questions here to throw out of the balloon, so we can get to something else. I guess on the macro side, okay, so the Fed is challenged, as you said. It doesn't have the world's best tools for this. And you talked about the fiscal side really driving what's going on here, and also the supply side. The worst of those shocks are behind us, correct? So
yes, I don't think we'll see the sheer speed of fiscal deficit deployment that we saw in 2020, 2021, and some of those supply side constraints are not as obviously severe as they were. And so instead, I think it's a more grindier type of problem now rather than like a impulsive problem.
Okay, great. All right, so now getting to the macro side of things. So you said a few minutes ago, and if the Fed creates a recession, you earlier said that you thought it's going to be a rough second half of the year. Can we avoid recession? I mean, there's so many indicators here that seem to indicate that the probability is on a flat line at best, and probably a recession. But I don't want to put words in your mouth.
I mean, I think in order to avoid recession, they'd have to give up on inflation, which Powell obviously doesn't want to do. And so
but would they do that for any other reason besides like saving the system, like something just starts melting down? Because Powell has been saying, guys, there's going to be pain in doing this. Like he's trying to prep us for a recession without saying a word.
Yeah, they're only going to do it to save the system. And I think the challenge is that they can cause recession, get inflation down, right? I think disinflation is the story for the next several months.
Yeah.
I think they can. When people say they want inflation to go away, what they're really saying is they want disinflationary growth, right? They want more jobs, more production, just more going on in the economy without the inflation. That's what they say they want when they want no inflation. If you say, well, we're going to get inflation to go away, but you're going to be in a recession, people are like, well, wait a second, that's not exactly what I want. That's that's out of the frying pan into the fire. And so I certainly think that they're willing to cause that. I think the question becomes then what? When you're in the recession and you then turn to more stimulus or less tight monetary conditions, when you accelerate out of that recession, I think the problem is that inflation, the underlying inflation dynamics are still there. And so they're ready to come back as soon as we want to accelerate out of that recession. And so unless you want to experience a period of permanent economic contraction, the inflation's still ready to keep coming back. And then the problem is, if you're in a prolonged enough recession with debt as high as it is, that's when you start bringing up system meltdown problems, right? Basically tax revenue starts to fall off a cliff while deficits are already $1.5 trillion. You start to get problems in commercial real estate cascading through. And so you get weird situations, kind of these types of 1940 style and combinations of high inflation and high debt are punctuated by periods where the central bank is unable to tighten even though inflation is above their target. That's ultimately what it comes down to. There's bursts of time where they just are unable to do so. And an example was the gilt market last year, where they were like, we're gonna do QT, and they just had to do this like burst of QE to fix the liquidity problem in their market. And I think we just kind of saw that with the Fed, where they're trying to be tightened, and they just increased their balance sheet and have undone multiple months worth of quantitative tightening in terms of total liquidity in the market, not necessarily because they bought assets, but because their loans are now offsetting some of the securities that they sold, and they're kind of a situation where inflation is still above target, but they've had to kind of decelerate some of their tightening efforts because certain powers are just out of their hands. And so I think that's what they're going to run into a couple of times, and I think they're willing to go through a recession to kind of show that it wasn't their fault. Like if they just let things run hot, then they get blamed for it. But if they try to tighten and they contribute to a recession, and then there's certain points where they have to respond to like broken treasury markets and stuff, they can just say like, these are the frameworks that we're working with, and we're kind of stuck here.
Yeah, yeah, and of course at that time too, everybody's once it breaks, everybody's screaming for the Fed to come in and rescue. So they get that little bit of that air cover.
Yeah.
Okay, so if I heard you correctly, you kind of think we're a recession is certainly. I'm going to use the word probable. Correct me if you want to correct it, but as long as the Fed doesn't step in with a systemic rescue, and it sounds like we should expect the Fed to continue to kind of have its foot on the brakes for the rest of the year, but periodically be stomping on the gas at the same time, episodically, as it's dealing with something that might be breaking and it's trying to fix it, like a spot fix.
Yeah, I think that's the way to look at it. And, there's certain, to the extent that the market prices in a less hawkish Fed, that's generally dollar negative and good for emerging markets. And so in some ways, the United States can be kept afloat by what's happening overseas. If China accelerates more, if certain emerging markets accelerate more, that could be otherwise decently good for the United States as well. And so in some cases, just the fact that the Fed's not as able to be as hawkish as they wanted to be can keep things afloat for longer than you might expect, because the dollar's coming off the high, liquidity is coming off of the depths that it was at, but it's still basically operating at stall speed is the problem. And so I think that's kind of what they're going for at the moment, is sort of that stall speed where they don't want things to outright break, but at the same time they want to be tight. They want to, they see how low official unemployment is, they see how high headline inflation is, and they basically want to have those lines meet. And they're going to, I think, stay in that kind of stall speed until they can try to get those to meet.
Okay. So just from a practical standpoint then, so, people who watch this channel are regular investors, or regular people. What should we expect in terms of just sort of our lived experience here? Like, do you expect to see the accelerating wave of layoffs that we've had going into this year to crescendo going forward? I mean, do you expect this to be a recession that would be accompanied by pretty substantial job loss? The housing market obviously has really started rolling over nationwide. Different markets are feeling the pain differently, but there's probably still a lot to go there, especially just factoring in the increase in mortgage rates alone. So like, how is this going to feel? How's the rest of this year going to feel to the average person, do you think?
So I think that's partially depend again on how these humans in charge deal with the situation. I think one thing that's instructive is the post-dot-com bubble recession, because even though that was one of the biggest bear markets in modern history, that was actually the mildest recession in modern history, in terms of basically over, say, like real GDP contraction, or the official unemployment rate compared to recessions that preceded it or that came after it. And it was also like a very sector specific type of recession. So obviously tech got absolutely wrecked.
Yeah.
Whereas in that environment, energy was fine, real estate was fine. Places that didn't really have excess to begin with were fine. Whereas like certain areas just got completely wrecked. And that, of course, cascades through a little bit. I mean, everything else kind of softens for a period of time because all those tech people that lost their jobs are consuming less. But it's the epicenter is kind of separate. I think it's somewhat similar here, where because the problems are more sector specific, this time it's tech and real estate. I think those areas are going to continue to be problems overall. While other areas, I don't really see like restaurants having like a cataclysmic recession anytime soon, for example, or travel companies, for example. I think we're going to probably see this bifurcated market that I think there's going to be some people that are either people that follow the markets or they're in those damaged sectors, or it's going to feel like utterly terrible to them. And there's other people that are going to be like, I see long lines everywhere. What's the problem? It seems fine to me. Inflation's still hot. I think there's kind of going to almost be like two different worlds for a period of time.
I mean, I would almost say we're there right now.
Yeah.
And of course,
I think that's probably going to continue to some extent.
Okay. All right. I'm going to ask you just a similar question, just to clarify one thing. So as mild as the 2008 recession was, and I know there are a lot of people watching who are going to say, hey, it didn't feel mild to me.
No, not the 2008 recession, the post.com recession. So like the one around 2001.
Oh, I'm sorry. Okay, great. Thank you. Okay. Yep. Then I'm not going to ask that question. Okay. Thanks for the clarification. All right.
No, the 2008 one was the most severe recession in modern history.
Well, you can understand why I was coming back with my questions, but you're right. I was remembering the wrong, I misinterpreted which recession you were talking about. Okay. So now the market outlook, right? So, maybe your answer is going to be similar, which is, hey, we're going to see some sectors get hit really hard. We're going to see some that don't get hit as much. In general, I'll say this, there's a general consensus of the folks that I interview on this channel that earnings probably still need to come down. Earnings estimates still need to come down to map closer to reality. That speaks for sort of a broad base repricing in the markets here. What are you expecting?
I think basically
our interview with Lyn will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. One thing about that bell icon, we've been hearing from a number of our viewers recently that they're not getting alerts when we release a new video on this channel. You have to have that little bell icon turned on. So even if you're a longtime watcher of this channel, do take a second to look down there at that bell icon. If it's not activated, click it now. And while you're down there, be sure to hit the like button too. And don't forget that replay videos of Wealthion's recent and very excellent online conference are now available for purchase at wealthion.com/conference. And finally, if the challenges that Lyn has detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks and opportunities that Lyn has mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next over in part 2 of our interview with Lyn Alden.